All right, everybody, welcome to another Market Talks with Dr. Stoxx session. We are looking at a chart here of FUTU. Now, as I promised members of our live trading room, this is coming to you from the Dr. Stoxx live trading room over on Discord. And if you're interested in joining, you can go to drstoxx.com, drstoxx.com. Click on the live trading room button, and that'll lead you to us, and you'll be able to trade with us. You'll see every trade that I take, my entry price, stop loss, target price, reasons for the trade, and all of that stuff. Plus, every afternoon I jump on the live mic and we talk about charts. So today I'm going to talk a little bit about two strategies that we use in the live room to make income every week. Does it work perfectly? No. Are there weeks where we don't make income? Yes. Are there weeks where we actually take a loss? Yes. But by and large, we've been doing this for months and months and months, and we started doing it back in 2021, which was my very best year of trading. 2022, the bear market became a little more difficult. 2023, we didn't do much of it. 2024, we came back online early on and started doing both wheel strategies and what I call a diagonal debit spread strategy. Let me just give you a brief explanation of each of those, and we can use Apple as a good example, and it's actually a very good stock for both of those strategies. So for the wheel strategy, which is the one I like the most, but it is the one that really tends to work best in a bull market, doesn't work as well in more volatile markets, which is kind of where we are right now, with the VIX up around 20 or something. What works better in a more volatile market is the other strategy, diagonal debit spread, which we'll talk about in just a minute. But let me just say that for any stock to qualify for the wheel strategy, it needs to have three things in common. It has to have weekly options, number one. Number two, those weekly options have to be sufficiently liquid that you can get in and out of them quickly on a Friday afternoon, which is the day that we do our rollouts. And third, there has to be sufficient premium in them to make the risk that you're taking on worth it. We need at least 1%, that's my rule of thumb, on a week-to-week basis of profit, pure profit, for us to consider it a viable candidate. So Apple is fine. You're going to make about 1.5% to 2% per week if everything goes well. It's very liquid, and it is in a stock that I don't mind holding shares of because I'm bullish for the most part on Apple. That's the fourth qualification, which I didn't mention, and that is that in this strategy, you will be holding shares of the stock, 100 shares per put that you sell short, when the stock goes below your strike price. And so you need to be bullish enough on the stock to be willing to do that. All right, so here's the wheel strategy. It moves in three steps. The first step is once we've found a stock we like, and Apple is actually a very good one, we put on a cash secured put. Now, what does that mean? It means that we're selling a put short. We do this 1 week out. Generally, we do this at or near the current price of the stock. So the strike price of our put will be at or near the current price of the stock, and it's 1 week out of time. So we do it on a Friday for the next Friday's expiration. We sell it short. We hold on to it. Next Friday comes around, and as long as the stock is trading at or above the strike price of the put, we take 100% premium, 100% profit, and we do the same thing over again. We continue to sell another cash secured put. What does that mean, cash secured put? Well, Apple is trading at $228. In order to sell one put of Apple's stock, you need to have $22,800 in your cash account or $11,400 in your margin account in order to do this trade. If you don't have that much cash, you can't do this on Apple, but there are plenty of stocks that you can do this on. Stocks, exchange traded funds, many of them have weekly options, and you can do it on something like a Ford, which is a $12 or $13 stock. You can do it on GM, which is a $20 stock. You can do it on PLTR, which is like a $40 stock. So you don't have to have that much cash, but you do have to have cash in your account enough to buy 100 shares. All right, cash secured put. Week after week, we keep rolling these out, selling at or near the money. We can go a little bit in the money if we think it's going to have a great week. We can go a little bit out of the money if we think it might pull back a little bit. But that's how we run that first step. Now, the second step happens when, on a Friday at the close, the stock closes below your strike price. Then you are going to be put shares, 100 shares for every put you sold short, at the strike price that you sold the put at. And then you have to cover those shares with a call. We generally sell calls at the same strike price as the put. We're not looking to make profit on the shares, but we are looking to take that income week after week. So the second step is a covered call. And we continue to sell calls short on the shares that we now own until we get called away. You'll get called away as long as the stock closes above the strike price of the call. If it closes below, you got to sell calls again. Third step. Once we get called away, here's the third step. Another cash secured put. We actually go back to step number 1 and we do it all over again. Rinse and repeat. And that's the wheel, right? So you go from cash secured put to covered call. You go from covered call back to cash secured put. You go from cash secured put to covered call. You go from covered call to cash secured put. And that's the wheel. Round and around and around she goes. And every week, ideally, as long as the stock isn't just collapsing altogether, you're putting income into the bank. That's the wheel strategy. Once again, you've got to be bullish on the stock or the index that you're doing this on enough to be able to hold 100 shares per put. That's the cash secured, that is the wheel play, so-called because of the circular nature of the strategy. Now here's a slightly different version of that called the diagonal debit spread. Still don't have a good kind of sexy title for this, but here's how this works. It's called a diagonal debit spread because we are putting on 2 puts, one long, one short, at different strike prices and different expiration dates. So again, you find a stock that has weekly options, they're liquid, they have sufficient premium, it's in a stock that you like, that you don't mind holding shares of. Now in this strategy, we actually don't hold shares of the stock. When we're about to be put shares, we just buy the put back. Sometimes we take a loss, sometimes we take a smaller profit, and then we sell another put. So we don't hold shares in this strategy, and you can do this one on a stock like Apple with a much smaller account. You maybe need about $2,000 of cash on hand to hold a debit spread overnight. So here's how this works. First of all, you need to determine a sufficient level of support for the stock. And you can see a pretty clear one here at about 224. Apologies for the noise in the background. My wife is vacuuming. So 224 is a good line in the sand. We don't really want it to go down much further than that. And we don't do this all the way out to earnings, so this wouldn't be a very good position to hold because earnings are too close to the current date to make this strategy worth it. But let's pretend that earnings is out in December somewhere. We're going to go probably out to November. They say the third Friday in November. And we're going to sell. I'm sorry, we're not going to sell. We're going to buy. This is the first part of the position. Buy to open a long put with time at a strike price that is at a place of support. That is our protection. That's our insurance. That's the thing that will cap your maximum risk. And that's why you can do this with a smaller account, because you won't need nearly as much cash on hand in order to do this position. So that's position number 1, buy to open, longer term put with time as your insurance. Now, for the most part, we're not going to touch that. We're just going to let it expire. And with a view that this will expire worthless. And yeah, you're not making any money from this put. In fact, you're probably going to lose money. And that's simply the cost basis of doing this position. It's what you have to pay to be able to sleep at night with this position. It's what you have to pay in order to hold this overnight without a whole lot of cash in your account. Okay. The second position, however, is going to be a sell to open. A sell to open, short put or put right. And we generally do this at the current price of the stock. So we figure out what the current price is, 228 currently. We have our protection down here at, I said 224. I have the line here at 220, but we probably would put it at 224. And we're going to sell short the 228 puts, and we're going to do that week after week after week, whatever the current price is. If it goes up to 232, we'll sell the 232 strike. If it goes down to 225, we'll sell the 225 strike. If it goes down to 220, we have an option. We can actually sell right at 224, and we'll take a lot of profit if it starts to travel north and gets back above that strike price. So there are a lot of options on that second leg of the position. For the most part, the first leg we don't touch. The second leg you can adjust on a week-to-week basis based on what the stock is doing. So that's it. Now, it's going to take probably a couple of weeks for you to make back the cost basis of that long put. In fact, I have a rule of thumb. If you can't make back the cost basis of the long put in 3 weeks, it's not a good candidate. Look elsewhere. Look for something else. So 2 to 3 weeks, we should be at break even on this, and then every week after that, we start to take profits. Well, does that sound enticing to you? Maybe not, but it's a much lower risk. It's a very good strategy in volatile markets, and you don't necessarily have to be that bullish on the stock because you're not going to own shares. In fact, some of the best trading vehicles for this strategy are stocks that are going sideways, kind of like Apple right here. Right? It's in a trading range between 232 and 216. And if it stays in that trading range, we can make money week after week after week selling short weekly puts. All right, so that's the DDS strategy. You learn the wheel strategy, the DDS strategy. I'm going to go ahead now and turn this video off, and then I'll re-record for our chart session together. Hold on just 1 minute.